People talk a lot about diversification for investing, but what is diversification and how does it work for us? That's what we'll be covering today. Hi, I'm Sean, and on this channel, we talk about how to get yourself further ahead using insights from the financial world. Now, whenever we talk about investing, we inevitably have to talk about risk. It's an inherent part of the game, just like in life. There's no such thing as a risk-free investment. And understanding this is crucial for any investor, especially beginners. Think of it like driving a car. Every time you get behind the wheel, you're accepting a certain level of risk. And the risk comes in two forms. On the one hand, you have the probability of an accident occurring, and on the other hand, you have the level of damage you suffer if an accident occurs. So whether you are seriously injured or only have a minor injury. There's always the chance of an accident, however small. But car companies have been working constantly to minimize those risks through innovations like seatbelts that stop us from flying out the window, or ABS systems that prevent us from skidding. These safety features are designed to protect you in case something goes wrong. The same applies to investing. When investing, I also have to regularly consider what risks am I taking and how can I prevent the risk of losing money. It is always important that you know how much risk your investments carry, because in the past, especially by private investors, but also large banks that later went bankrupt, or insurance companies, big mistakes were made in risk assessment because investors only looked at high returns and forgot the principle that high returns also means increased risk. Those who want more security usually have to settle for less return but then have it with a higher security. This is why Italian government bonds, for example, yield more return than German government bonds. Investors simply want to be compensated for a higher risk, and that is why the Italian state has to pay more interest. So why is Italy riskier? This is simply because the probability that Italy will not be able to repay its debts or only partially is estimated to be higher than it is for Germany. Let's look at Greek government bonds, for example, where there was a debt restructuring not so long ago, which means that some investors did not get any money back from their bonds, or at least only partially. The returns are significantly higher there because the risk of not being repaid is higher. Countries that are considered less risky therefore pay less interest to their investors than countries that are considered more risky. Now that we know what risk is, we have to think about how to reduce the risk of our investments. And that's where diversification comes in. It's the seatbelt of your investment portfolio. You've probably heard the saying, don't put all your eggs in one basket. Why do people say that? Well, if your basket falls over where all the eggs are in, all the eggs are broken at once. This means we have to spread the eggs across different baskets. Diversification is precisely that. Spreading your investments across different assets to minimize your risk. And to know how to minimize risk, we first need to know that there are two basic types of risk. There is the individual risk of a security, and then there is a general market risk that every security carries. Let's look at this using an example. If you are a homeowner, you have an individual risk on the house, for example, a fire. If you forget to blow out a candle or it is struck by lightning and it starts to burn, that is the individual risk of your house. The same applies to a company. Companies also have individual risk, such as having poor management or going bankrupt because they are no longer competitive or are involved in lawsuits that only affect this company. Market risk, also known as systemic risk, is a general risk. If, for example, your house is hit by an earthquake, this also affects all the houses around it. The same applies to companies. If an entire market loses value, such as the US market during a market crash, then all companies in the US market are affected, no matter how good or bad the company is. Even if it has a very good market position, the probability is very high that the share of this company will lose value. Now that we know the two main types of risk, we have to think about how we can eliminate them. We can eliminate individual risk by using the insurance model. If you want to insure your house against fire, for example, you pay the insurance company a premium and have fire insurance that covers the financial risk that if your house burns down or suffers damage, this financial amount will be reimbursed by the insurance company. The insurance company can afford this because it insures many thousands of houses and thus spreads the risk. For example, it knows that if the fire risk is 2%, it will have to replace or repair about 2 out of 100 insured houses a year. Because of the large number, the insurance company knows how high it has to set the premium in order to be able to replace the expected damage. So it has spread the risk across a large number of houses. The same applies to investing. It doesn't make sense to put all our money on one company or in one stock with a high individual risk. It makes more sense to spread this money across different companies, ideally also different countries and different sectors. Just like with insurance, you reduce the individual risk, and you can minimize market risk similarly to individual risk. For example, if in our insurance and housing example, there is a dry period in a particular region and the fire rate increases from 2% to 10%, this can quickly mean the end for the insurance company if it cannot adjust the premium for this. To counteract this risk, the insurance company can add other insurance models. For example, insurance against flooding, earthquakes, and other damage. In addition, the insurance company can decide to operate in different regions. This means it has positioned itself in different business areas and at the same time has also diversified regionally. If we now apply this to our investments, it means we should spread our money across different baskets, so invest in different countries, invest in different sectors, and invest in different asset classes. So examples of these asset classes include stocks, so representing ownership in companies, or bonds, which are essentially loans to governments or companies, or real estate, so investment in properties, or commodities, so raw materials like gold, oil, or agricultural products. And then there's also cash and cash equivalents, so money in savings accounts, money market funds, etc. By holding a mix of these asset classes, you're creating a more balanced portfolio that's less susceptible to major losses from a downturn in any single area. Now, a crucial aspect of diversification is understanding correlation, which measures how closely the prices of different assets move together. Ideally, you want to hold assets with low or negative correlation. This is where modern portfolio theory, or MPT, comes into play. MPT suggests that by investing in uncorrelated assets, you can increase your return per unit of risk, making your investments more efficient. Think of it this way. If you invest in two companies that are in the same industry and are heavily reliant on the same economic factors, their stock prices are likely to move in the same direction. If one company does poorly, the other is likely to follow the same path. But if you invest in companies from different industries or sectors, their performance is less likely to be tied together. For example, banks might benefit from rising interest rates, while real estate companies might suffer. Holding both can help balance out the impact of interest rate changes on your portfolio. Now, here are some practical steps to diversify your portfolio. Number 1 is start with ETFs or mutual funds. These investment vehicles offer instant diversification across a basket of stocks, making them a great starting point for beginners. They're like pre-made diversified portfolios. I made a short video explaining ETFs, which you'll see above or linked in the description below. Number 2 is gradually add individual stocks. As you gain experience and accumulate more capital, you can start incorporating individual stocks into your portfolio, but always maintain a diversified approach. Avoid concentration in any single company or sector. Just FYI though, active stock picking like this usually underperforms passive investing methods like just investing in ETFs to broadly track the market. In fact, even for professional investors, this is extremely difficult. According to Morningstar, depending on the region, passive index tracking funds actually outperform 75 to 95% of actively managed funds. So be aware of this before you think about going stock picking yourself. Everyone thinks that they're smarter than the market, and very few actually are. You might get lucky and do better than the market for 1 or even 3 years, but over 30 years, that's very unlikely. And number 3 is avoid overlap. Be mindful of overlapping holdings when selecting multiple ETFs or mutual funds. The same companies or regions might exist in more than one ETF you're holding. You can use online tools to compare 2 different fund holdings to see whether or not you're accidentally doubling down on the same investments. But anyways, you can see that it is inevitable to deal with risk and risk minimization if you want to invest money. Insurance companies and banks employ whole armies of mathematicians and controllers who do nothing all day but assess risks and think about how to prevent these risks. But in my opinion, especially if you're watching this video and you want to be able to start investing in a diversified way without too much effort, then I would suggest you would learn more about ETFs. And I actually made a video explaining all you need to know about ETFs right here, and you'll definitely want to check it out. All you need to do is click it. It's right here, I think. Do it, and don't forget to like and subscribe. Cool. I am slightly insane.